Hello and welcome to today's homebuyer class. My name is Phil Ross and I will be one of your two instructors for today's class. I am a loan specialist with Doorway Home Loans and excited to share some valuable information with you. So let's go ahead and get the ball rolling here. Some housekeeping items real quick. This is a two-part curriculum. First part, yours truly will be sharing the lending portion of our class, and then we'll take a quick break, and then we'll be finishing today up with Joana Evans from John L. Scott. She will be covering the real estate portion of this class. So it is listed technically as a 5-hour class, but however, we're going to try to get you out much sooner than that. I'll try to get this done within 3 hours here, so have you back in about your way this weekend. So, but did want to make sure that we let you know that it is technically a 5-hour class, but we'll try to get it done much earlier for you. Try to fast track it for you. So we will be taking some breaks along the way, let you stretch out and make sure that we break up some of the monotony of some of the learning that you're going to have today. And then we do encourage you to use the live chat for any questions that may come up as we're going through the presentation. We're trying to keep the presentation moving forward, but along the way, we'll be checking the chat in case you have any questions that pop up. So please do not hesitate to chat any information in there. Matter of fact, if you wanted to, if you don't mind, if you could just do a test run and just put it in the chat and say, hello, my name is, and go from there just as a test run. So we can see how many people we have on the line today. But anyway, the other thing I wanted to point out is to make sure that you stay to the end of the class. We will be sharing at the end of the class just to make sure that you've attended for the entire time. Of course, this is a virtual class. The state has asked us to do an action item at the end just to ensure you're here. So stay tuned for that. We will be giving you some handouts at the tail end here, but we need you to do the action item that we're going to ask at the end of the class to obtain the information. As you can see here, you will be receiving a certificate of achievement just to show that you've attended this class. This certificate is good for up to 2 years, and it applies if you're getting any kind of special programs or assistance. Your lender will be asking for that. So once we send this information to you, you want to keep it in a safe place. Also on here, you'll see a registration form, also a workbook in case you want to go back and just kind of dot your I's and cross your T's on some of the information I shared in the lending portion. You'll find much of that in the workbook that you receive there. We'll send that out in PDF format. Last but not least, there's an assessment form, just kind of a survey just to see what you got out of the class and what you thought about it. So if you don't mind, we'll have you fill that out. But we'll cover this information again at the tail end. So I just wanted to give you heads up that we will be sending this out to you. All right. So let's go ahead and get things started. As I mentioned, I cover the home financing portion of this, which is, of course, the funds to obtain a loan. So really my mission in teaching these classes is to really reduce the confusion out there when it comes to home buying. I know, because I was a former first-time home buyer myself, the confusion that goes in there. Where do I get started? How do I find this information? What's first, what's second? How's the process work? So what this class is to give you that information, give you the items that you need to know, because you don't know what you don't know when you're first starting out. The other thing is to let you know what to expect, what's coming along the way. So there's going to be a slide where we'll show you the entire process from start to finish to help alleviate, give you more clarity on what that is, what to expect. And really just to simplify what otherwise can be seen as complex when it comes to buying a home. Everybody pretty much freaks out when they're buying a home anyway. So if you're one of those, don't feel alone. Everybody does. It can be overwhelming, and that's what this class is all about. is to reduce that and just give you the information you need to know so you have the peace of mind to move forward. Okay. So I always like to start things off with my personal journey as a home buyer, first time home buyer. Back in the day, as you can see, I actually had some hair back in my mid 20s. My wife and I are out looking. Unfortunately, unlike you guys, we didn't have the ability to go to a home buyer class and get some of the cheat notes that we needed to move forward to make the process a much more enjoyable process of in our road to home ownership. So we stubbed our toe all the way, to the finish line because we just didn't know what we didn't know. So once I got in this business, somehow, some way, I did stumble into this business. I pretty much made it, excuse me, just it was my mission to, if I was going to work in this industry, to really just focus on just making the process much smoother for potential buyers. So that's what I do. That's the lion's share of my business, and how I get my business is what you're seeing today. It's me doing presentations and just speaking in plain language that and empathizing with the home buyers so we can make your process as smooth as possible. And the cherry on top for me, honestly, what's kept me in this business for 27 plus years is handing those keys, being able to see you get those keys in your hand. That person who just never truly thought they can get in a home, getting those keys and having that conversation is always best. It just rejuvenates me to stay in this business. So I really love it. So so what we're going to cover today, again, is the loan process as a whole. In the upcoming slide, I'm going to share with you share with you the entire process visually, just so you have an idea. What I've learned in teaching these classes, if we show you the entire process from start to finish early, everything else that we share in our presentation kind of resonates a little bit more for you. So we'll make sure we do that. Along the way, we'll cover some deadly mistakes that many home buyers make in today's market. A lot of times you have people in your ear, and all of a sudden everybody's an expert when it comes to buying a house. And unfortunately, a lot of times I see home buyers shooting themselves in the foot because a loved one who was trying to give them some advice was the wrong advice based on their situation. So we'll talk more about that, so you guys are aware of some of the most common mistakes that home buyers make. Buying a home isn't as difficult as many think, but when you mix in all the mistakes and everything and the anxiety that people have when it comes to buying their first home, it just kind of gets it blown a little bit out of proportion. So kudos for you for being here today, because that's what this class is all about, is getting rid of all those mistakes and myths and all those things. Okay. We'll also touch on what lenders are looking for. What does a lender want from you as a home buyer, as an applicant who's looking to buy a house? So we'll touch on that. We will cover some common myths and misconceptions that are out there as well when it comes to home buyer, that I hear quite often. So I'll be touching on those. Again, as you can see, the theme here is giving you guys clarity and peace of mind from start to finish. And then we'll finish things up with some available assistance programs here in the state of Washington, along with some of the some of the pros and cons that are associated with those programs as well. All right. So here's the first slide. So often I'll get a call from a client, or maybe Jonah will get a call from a client, and the conversation goes something like, hey, Phil, my lease is up in a few months. Matter of fact, I just got notification that my landlord is going to raise my rent. I'm already paying $1,700. If I'm going to pay $1,800, I want to possibly look into buying a house, because that feels like a house payment to me. What should I do? So the first thing that person wants to do, what I'd advise that person to do to get started, is to connect with the lender, like myself. A loan specialist is going to assist them along the way. I'll have them apply for a home loan. And what that's going to do, number one, is let them know, are they pre-approved for a home loan? And if so, what are some of their financing options, such as what's their maximum purchase price, that they can buy what kind of different program options are there? Are there, what kind of monthly payment can they expect? How much cash out of the pocket? All those things happen in a pre-approval process. Pre-approval is free. Getting a pre-approval in most cases, if someone's charging you, then just go down the street to the next lender, because typically it should not cost you anything, but it does give you the information you need to know. Now, once you're armed with that information, you want to connect with the real estate agent, go out and start familiarizing what's available out there, in different neighborhoods based on your price range. Once you find the right house, you make an offer, assuming that the seller accepts the offer that you made, you are now in what's called mutual contract. So the next step here, if that is the case, is that before your loan process really starts, you want to have a home inspection done. Okay. Now, what this is, it just tells you, a home inspection tells you as a home buyer if there's any true deal breakers. And you'll probably preview this with your real estate agent back and forth, that are there any deal breakers on that home that will make you want to, either go back and renegotiate your offer with the seller, or maybe, if you don't hear the numbers that you want, it gives you the opportunity to get your earnest money back and cancel that contract and get back in the market. But let's assume that your home inspection turns out just fine. Now the loan process really starts. We call this the documentation phase. And here, your lender is going to ask for a lot of updated information that they probably received from you in the beginning when you applied. So let's say you applied and it took you 2 or 3 months to find the right home. Your lender is going to ask for updated pay stubs, bank statements, things like that. Also, your lender is going to reach out to third parties during this documentation phase, such as the appraiser, who's going to tell the lender if the house is at least worth the amount that they offered for it. Title company, to make sure there's no liens or judgments against you or the seller who's trying to sell the home. Going to be contacting your insurance agent. We're going to be contacting your employer, things like that. So all this is usually about a 2-3 week period where we're collecting this information. Is coming in, goes to your lender's processing team. They prep it over to an underwriter who's pretty much a quality control person who's checking things off as they go. Okay. Everything checks off. You get what's called a final approval. Lenders also call it clear to close. It just means that you're all set. Only one step left, which is for you to go in and sign your final paperwork. Okay. Now, before you sign your final paperwork, typically 3 days prior, you'll get something, at least 3 days prior, minimum 3 days prior, you'll get an email out from your lender, which is going to break down all the terms of your loan, everything from your loan amount, your purchase price, cash you need to bring to the closing table, monthly payment. You'll get an opportunity to review that before you go in and sign your final paperwork. Then you go in and sign your final paperwork. Typically, you're not going to get the keys that day, though. Typically, it goes back to your lender. They review everything, wire funds, it gets to the escrow company, and then they give you recording numbers, and you are officially closed, typically a day after you sign. All right. So that's pretty much it. That's how the process works. And usually from the time you make your offer to the time you receive your keys can be anywhere from 20 to 40 days, just depending on how your process went. But that's how the loan process goes. So just as a reminder too, as I'm going through these slides, if you have any questions, please enter them in the chat and we'll keep things moving right along here. All right, so one of the most common daily home buying mistakes that we see out there right now is delaying getting pre-approved. Okay. Now, the reason why getting pre-approval is so important for you as a home buyer, it's an important step, is number one, it's going to give you clarity, reduce all the uncertainty. What do I qualify for as far as a house price? How much cash out of the pocket am I going to need? What's my monthly payment going to be if I buy it? $500,000 home. What if I buy it at a $300,000 home? So on and so forth. You want to know that information up front versus having all that information jingle, just going around with unclarity in your mind. That's why getting pre-approved is so important. The other thing is it gives you a personalized roadmap on what you need to do as a home buyer. Okay, not what someone else did, not what your neighbor did, not what your aunt or uncle did when they bought their house, but what you need to do. Okay, and everybody's situation is different. Okay, we like to think it's cookie cutter when it comes to buying a home. It's not. Okay, so get your personalized roadmap and reduce that uncertainty. Last but not least, it serves as your golden ticket. Okay. And what I mean by that is I'm a child of the 70s, so I used to love Willy Wonka. And the thing about Willy Wonka, the first part of the movie, which is kind of slow, the first part, but you could not get through those gates to his chocolate factory unless you had that golden ticket. And that's what a pre-approval letter will do for you too. Once you get pre-approved, it's going to give you the golden ticket to go out and put in an offer on a home if you find that right house. However, if you don't have a pre-approval letter, you find that right house, and the first thing that seller is going to ask is, are you pre-approved? If you say no, they're going to send you on your way, and it may take you a day or two or even a week or so to get that pre-approval letter. In this hot market, if you circle back, that house is probably gone at that point. So best to have that pre-approval in hand, serves as your golden ticket. All right. So next, let's talk about the pre-approval appointment here. What's that all about? Okay, so when it comes to getting pre-approved, the first thing to know is that there's no right or wrong way to do it. You can get pre-approved online, filling out an online application. You can get pre-approved over the phone with your lender, or you can go into their office if you choose. But just do whatever is most convenient for you. Okay. Now, the key is to be candid. Do not try to suppress information to try to get your loan approved. You want to have the opposite mindset. You want to be open and honest and let your lender know of certain things that may not be on the surface, such as you might be going through a divorce or separation, or maybe you are going to, be getting laid off or take a pay cut. Those type of things, let your lender know up front, so we can try to best advise you and head some of those things off so you're not spinning your wheels and you're not spinning your lender's wheels as well. Okay. Now, personally, I like to go through a questionnaire either before I have my clients apply or once they've submitted their application. So I'm going to give you a few questions. If you got a pen or pad, you may want to write these down just to make sure that you're sharing this information with your lender. Okay. Some of the questions that I ask as a lender that I want to know from my buyers is how soon you're looking to buy a home. Okay, that's one key question because there may be some special programs coming up or some guideline changes coming up that I need to make you aware of. Okay. Another key question is how much cash on hand do you have to put towards buying a home? Okay. Those funds could be used towards your down payment. Maybe they could be used towards down payment and closing costs. Maybe they can be used towards paying down a debt or two to help you qualify for the loan amount. Okay, so no right or wrong answer on this questionnaire stuff. Just it just gives your lender more information to work with. Another key question is monthly payment. What's that monthly payment you're going to be comfortable with? But maybe it gets $100 higher than that number, including your taxes, insurance, everything that's lumped in. Let your lender know that so they can make you aware when you're starting to get closer over your comfort zone. Okay. Property. What type of property are you looking for? Are you looking for a single family home? Are you looking for a condo? Are you looking for a duplex? Are you looking for a manufactured home? All important information. Maybe it's all of the above. Let your lender know that up front. Very important when you're looking to get pre-approved and know what your options are. And then lastly, I would say one of the other most important questions is what areas do you prefer to live in? Okay. Again, no right, wrong answer there. It just helps your lender, just in case there's some special programs available in those areas. Okay. Once we do the questionnaire application, make sure you get that filled out to the best of your knowledge. Answer all the questions. Don't freak out too much on the loan amount when you're trying to figure out what you're approved for, purchase price. Just put a ballpark number in there, and your lender is going to usually let you know what your maximum you qualify for anyway. It could be way different than the number you put in there. So don't freak out on that. If you don't know, just put anything in there. And then I would say once that you submit your application, your lender is going to review your application, and now they'll know what type of documentation to request from you. Okay, so if you're W-2 wage earner, they're going to ask for your last 2 years W-2 forms, plus maybe your bank statements and most recent pay stub. If you are self-employed, we may ask for your business license and your tax returns. If you are on a fixed income, we may ask for your benefit award letter. Key in documentation is get your lender everything that they've asked for, okay? So often I'll give my clients a list of 4 or 5 things and give me 3 of those 4 or 5 things. Try to give them everything or forward over what you have. And if you can't find something, communicate that to your lender, and there's usually a workaround. But don't just send them, 3 out of the 5 things with no comments behind it, because now that stuff just sits and piles up. Because trust me, your lender probably has, 5 or 10 other people who've done the same thing. So do your best to get your lender everything that they ask for. If you can't find something, let your lender know that, and they may be able to work around that to get you the answers you need. All right. Now, once you get your documentation over to your lender, they're going to put you through a pre-underwriting system that's going to tell you whether your loan is approved or denied. Okay. Now, assuming that you're approved, your lender is going to go over options with you, such as your maximum purchase price that you qualify for, the different programs, how much cash out of pocket you might need, monthly payments, all that. Okay. Now, if you're not approved, what your lender is going to do is give you your roadmap, your personalized roadmap, as I talked about, on what are some of the things you need to do to put yourself in a position to buy. Okay. And then last but not least, we like to leave you with some best practices. What are some of the things you need to do to put yourself in the best position once you find your home, to make sure you have a smooth closing? What are some of the things that you do not want to do, that you want to avoid? If you're about to do these items, get on the phone, call your lender before you shoot yourself in the foot. Okay. So let me jump into my next slide, which is what lenders are looking for. Okay. I said early on, we're going to really simplify what lenders are looking for. So here you go. It's an acronym we call ATR. It's your ability to repay that loan. Okay. Your lender wants to know the likelihood. They're trying to figure out the likelihood that you can make that monthly payment, mortgage payment that you're applying for over the next 3 years without any failure, without any 30-day late, is really what they're looking at. Now, you may be asking, well, why 3 years? Why not more than 3 years? Because lenders know that life happens. Anything can happen beyond 3 years, but if we try to go too far out, then no one will get a loan, because we'd be overanalyzing stuff and often making mistakes. So lenders are really saying to themselves, based on this information we have in front of us, do we feel like this person or this couple can make this payment? Okay. Now, here are the parameters that lenders will use for the main parameters. There's 4 of them. Number 1 is your credit. What's your track record of repaying the people that you already owe? Okay, that's number 1. Number 2 is income. Okay, what's your capacity? What's your ability to make that monthly payment on time for the next 3 years? Okay, not only how much you make each month, but how stable is that income is something that lender is looking at. We'll talk a little bit more about that in the upcoming slides. The other item that lenders are looking at is your debt. Okay. What out there will be offsetting your ability to make your monthly mortgage payment? What obligations that you already have, including that new mortgage payment. Okay. So this is why you can have 2 people with the exact same credit make the exact same amount of money each month, but one person qualifies for a $500,000 loan. The other person is lucky to qualify for a $100,000 loan. What's the difference? It's debt. Okay. Maybe that person who's lucky to qualify for a $100,000 loan went out and bought a new boat or bought a car with a $1,500 payment, and it's eating up all their buying power. Okay. which brings me to my last measurement, which is debt to income ratio. And what this means when you hear a lender or a real estate professional say debt to income ratio, all this means is the percentage of income that you have coming in that has to go back out to pay debt. Okay, so maybe you have $10,000 in, let's just say $10,000 for round numbers in monthly income. Okay, 50% of that is the max debt going on, including your new mortgage payment that you're taking on and any other credit cards, car payments on. So make $10,000 a month. Your lender doesn't want to see any more than $5,000 going out to pay debt, including the new mortgage payment. I know that $10,000 might be high for some of you, but I'm just using that as a nice round number, for example. Okay. So 50% typically is fine. Anything over 50%, depending on the type of loan that you have, is going to probably get you a little bit, be in the turbulent zone as far as qualifying. In some cases, it's going to be 45 to 50%, we'll say, for debt ratio. All right. So now that you know that information, let's dive a little bit deeper into each one of those 4 parameters, starting with credit. Okay. Now, when it comes to credit, what your lender's using is going to use 3 different credit bureaus, which you see here on the screen. The most common being Equifax, Equifax, TransUnion, and Experian are the 3 most common ones that lenders use. Okay, and what the lender is going to do is take the middle of the 3 scores. So if your Equifax score is 700, your TransUnion score is 650, and your Experian score is 490, it's the 650 score that we're going to use. Okay, now you have 2 people on the credit and one person, on the application, excuse me, and one person's middle score is 650 and the other's middle score is 580. Together, your middle score is 580. It's always going to be the lower of the 2 is what the lender is going to use. That's why sometimes you can find married couples and one spouse is on the loan. The other spouse may not be on the loan because together they don't qualify because one of their scores is lower. Okay, and typically lenders want to see a credit score of about 640 or higher. Okay, will they go below 640? Certainly they will. But I always, for the sake of this class and the sake of a smooth transaction, I always tell clients to shoot for 640 on their credit score, because if so, they're more likely to have a smoother transaction. Okay. All right. So one of the common myths that I hear when it comes to credit is, hey, Phil, I would apply and buy a house, but I have poor credit, and maybe that's the case, but more often than not, what I find is that person who's saying they have poor credit had poor credit. Maybe they had some situation 2 or 3 years ago, maybe they got laid off from work, what have you, couldn't make their payments, fell behind. As long as that person got back on track and stayed, brought everything current and had no lates, over a 12-month history period going back, their credit score is probably back to normal. So what I'm saying to you is, anyone on this call, even if you feel like you have poor credit, get back on the saddle. All you have to do, you're most likely just a year away, sometimes 3 to 6 months away from having your score being right. So let's take a closer look at what goes into your credit score. Okay. Now, the biggest chunk of your credit score is past payment history. Okay. So what this means is, really in a nutshell, you don't want to have any 30-day lates going back the last 2 or 3 years. Especially in the last year, really can impact your score. Okay. So what I tell clients is to stay away from any 30-day lates for the rest of your life. Why? Because it has the biggest impact on your credit score. And the other thing is that only time heals it. You got to wait a year, 2 or 3 before it doesn't really impact your score as much. Okay. Now, the next item is balances on credit cards. And really what this means is, on any one credit card, if you ideally want to have less than 30% charge or balances on the total credit limit that you have. So let's say you have $1,000 credit limit that you can charge on. You don't want to go any higher than 300 on that 1,000. Once you hit 301 or higher, it's probably at some point going to start pulling negatively on your score, impacting your score negatively, I should say. And closer you get to that full 1,000 or 100% of your balance that you can charge, you're killing your score. Okay. Let me give you an example. I had a client who had a I think she had a 619 score. Now, typically on the program she was going for, she needed at least a 620. She was 1 point away. And I looked at her credit, perfect payment history as far back as I could see. However, she had, when I looked, I knew it had to be credit balances. And sure enough, she had just opened up a credit card where she can charge $1,000 on her balance. And guess what her balance was? It was 1,084. So she was 1 point away, but it was because she had overcharged on her balance. So I didn't need her to pay it all the way down to 30%. I didn't need her to pay it off. What I needed her to do was get it under. I said, we only need 1 point here. So get that balance down to 980 on that $1,000 high limit. She did. And the score jumped up to 645. 45 days later, she had the keys to her home. So that just gives you an example of how credit balances on credit cards can impact your score. So ideally, in that case, she would have been down to 30% if she was trying to maximize her score. In our case, we were just trying to get her qualified. Okay, so keep that in mind when you're looking at credit card balances. On any one credit card, ideally, you want to keep that balance no higher than 30%. Okay. Now, 15% of your credit profile is based on length of credit. This is why you may hear someone say, hey, when you pay off a credit card, be careful not closing that account out, because if you close that account out, you may have established 5-10 years of good payment history. You just wipe that payment history, that good payment history out. It's now no longer being factored into your credit algorithm. So be careful on that. 10% of your credit is amount of new credit you've obtained. Okay, so this can work in your favor. If you don't really have a whole lot of credit, you're able to open up a new credit card. That's going to work in your favor. It's going to bump up your score a little bit. However, don't keep opening up new credit cards, please. At some point, if you get beyond, 3 or 4 credit cards, it may work against you, because the algorithms are going, okay, wait a minute, this person's a bankruptcy waiting to happen, because they just willy-nilly keep opening up credit cards. What if you get laid off from work? The algorithms think you might start living off a credit card. So be careful. 1 or 2, maybe 3 credit cards. Don't get too crazy with it. And then last but not least, which counts for about 10% of your credit, is types of credit. So what this is saying here is that it likes to see a variety. It doesn't want to see all credit cards or all student loans, but kind of a mixture of installment and revolving credit accounts. Grab a quick drink of water here. All right. So let's talk about some of the common credit missteps that we see when it comes to obtaining a home loan. This one may surprise you: paying off collections. Be careful paying off collections. In many cases, you're perfectly fine if you pay off a collection, but there have been instances where I've had clients who are pre-approved who have gone out and paid off collections, and all of a sudden their score dropped dramatically. Okay, so be careful on that. I'm not trying to freak you out or nothing, but the best practice is, if you're not sure, call your lender. If we didn't ask you to pay off collections, let's get those keys in your hands first before you jump out there and do that. Okay, because the possibility that it could pull your score down. All right. Also know that Credit Karma and other credit simulators are great, because what they do is help you kind of see how your credit is trending. However, know that they're credit simulators. Okay, they're trying to simulate what some of the credit bureaus that I just showed you are doing, and they're not always right on when it comes to the numbers. A lot of times they're off. Okay, and so I've had people yell at me because they think that Credit Karma and some of these companies' credit score is the gospel. It's not. It's just a simulator. Okay, so keep that in mind. And then last but not least, make sure that you stay away from trying to self-diagnose what you need to do to be qualified for a home loan. I just shared with you a lot of information on how credit scoring works. Don't try to figure it out on your own. I just did that for your common knowledge, just for the store up here. But if you want to buy a home, get pre-approved and let the lenders let the computer tell you what you need to do. I guess I could show you better than I can tell you. So let me show you what I mean here. So here's a client who had a 480 score, and he really wanted to buy a home. He said, "Hey, Phil, he self-diagnosed himself that what he needed to do was take a settlement that he was getting for about $12,000 and pay off all his debt." So I was like, "Andre, before you do that, can you allow me just to, you apply for the loan, allow me to do what's called a credit analysis, a simulator, to make sure we can see truly what's going to impact your score." So he did. And what we found is that he did not need $12,000 to pay off all his debt. All he needed was just under $900 to pay down a BECU credit card balance, and he didn't even need to pay that all the way off. He just needed to pay the balance down to 100, and he needed to open up a secured credit card for like $300 but not charge anything on the balance. And his credit score was going to go from 480 to 642. Surprise, surprise. Just saved him $11,000. The other key thing is the time frame. He thought he had self-diagnosed that if he had done that, his score was going to go up immediately, or at least within the next couple of months. Not really the case. It was going to be a couple years just based on the bad credit marks that he had on his account. But at least he knew, and he had his own personal roadmap on what he needed to do. Okay, so encourage you, please don't try to self-diagnose. Even if you've got maxed out credit cards and things like that, don't try to figure that stuff out on your own. I can't tell you how many times I'm able to hand someone a pre-approval letter who may have that same situation. So everybody's situation is different. Let the professionals use the tools that they have to get you the information you need. Okay. Now, another common question comes up, because I've been teaching these classes so long, I almost know some of the questions that are circling in your mind is, "Hey, Phil, wouldn't pulling our credit pull our score down?" Not necessarily. And if so, not to the extent you think. In most cases, pulling your credit score does not pull your credit score down unless you've been out there shopping for credit previously. And even then, it's not going to pull it down much at all. Maybe here or there. The problem is, it's kind of the which comes first, the chicken or egg. We cannot get you pre-approved without getting your credit score, pulling your credit score. So you need to, if you want to seriously buy a house and get your roadmap, have your credit pulled. You don't want one of these pre-qualification things out there. They're worth nothing. I just had a client call me the other day and said she had got a pre-qualification from her bank or something like that. And she couldn't get the people back on the phone. There's a pretty good reason for that. It's because pre-qualifications aren't worth anything. You want to have what I just showed you in the pre-approval process. You want to have your lender underwrite that loan, so you're not spinning your wheels. There's just way too much on the line for you not to have some more definites, and it starts with having your credit pulled. Okay. Let's talk about income. So we talked about credit. Now let's jump into income a little bit. Now, when it comes to income, your lenders are looking at your gross income before any taxes or deductions are taken out. Okay. And what they really want to see is a 2-year stable employment history. Okay. This does not mean you need to be with your employer for 2 years. That's a myth. Okay. But what it does mean is that if you've changed employers or not, really what your lender does not want to see is that you've had an extended gap of employment, like 4 to 6 months going back the last 2 years. There are some exceptions to that rule. One is if you are any kind of school or training or military, then that counts just like you were working, even if you were out. So that closes the gap. So if you happen to get laid off, but you went back to school or some kind of certification, that closes the gap. So you're good to go. Okay. Also know that fixed income does not require a 2-year history. We can use fixed income such as Social Security, retirement from day one that you start receiving that, as long as you can produce some type of benefit award letter that shows you'll be receiving that payment for at least the next 3 years. Okay. Now, you may be wondering what's considered unstable income. Unstable income are things such as overtime, bonuses, commissions, second or third job, or self-employed. Okay. All these type of incomes, as far as the underwriter is concerned, is easy come, easy go. We will use it, but we need to show that you received it for 2-year consistency. Okay. Your lender doesn't want to use overtime that you've been receiving from your employer for 6 months, and then all of a sudden your boss cuts off your overtime and you have the keys to a home that you can't afford. Okay. So that's the reason behind that. If you have any questions on that, feel free to throw that in the chat. All right. So debt, when we talk about debt, we're talking about those items that show up as a monthly obligation and how that impacts your buying power. Okay. And there's different types of debts. There's standard credit accounts, which simply show up on your credit report. It'll show the name of the creditor. It'll show the balance. It'll show your monthly payment. Okay. Then you have items on your credit report that show not in repayment, such as deferred student loans. Okay. Know that your lender in most cases is going to use 1% of that balance. Okay. So if you got a student loan for, $50,000, that's going to be a $500 payment that your lender is going to plug in on your monthly payment if it shows as a deferred payment. Okay. Collections, your lenders typically, even though we don't want you paying off collections, and even though a collection, you typically don't have a monthly payment arrangement, your lenders, in many cases, or in some cases, I should say, are going to plug in 5% of the balance, especially if it's over $1,000 or $2,000. Okay. And then judgments and liens typically need to be paid in full, and any kind of child support or 401k that's deducted out of your monthly paycheck, that will also be factored in, even though some of those items do not show up on the credit report. So just be aware of that. And then lastly, I don't have it on the screen here, but if you are utilizing a government loan such as FHA, USDA, or VA, which we'll cover later on, and your spouse is not going to be on the loan, your spouse's debt that's in their name still counts as your debt. Okay, so just keep that in mind as well. All right. We'll cover more of that in detail in some of these upcoming slides. So I do want to cover how we come up with what you can afford on your monthly payment. Okay, so here's how it works. How we come up with what you can afford on your monthly house payment is we simply are going to take your gross income, and then whatever program we're on, we're going to take the maximum debt ratio. In this case, it's 50%. So what this lender is saying is we don't want your monthly payment, your monthly outgo, including your mortgage payment, to be any higher than 50% of your gross income. So in this case, this person brings in $3,870 a month. So $1,935 is the maximum total debt allowed, including the new mortgage payment that they plan on taking on. So how do we come up with that max mortgage payment they qualify for? We take that $1,935, which is half of their income, 50% of their income, and we subtract out any existing monthly debts that they have, and we come up with the max house payment. So in this case, this client's monthly payment should not exceed $1,715 to qualify for the loan that they're on. Okay. Now, just in case you're not aware of what goes into a monthly payment, let's touch on that real quick. Okay. Now, one of the first items that goes into your monthly payment is called a principal and interest part of your portion of your payment, which is all that really means is your starting loan balance, including whatever interest rate you have, will make up that payment. In this case, we're going to say it's $1,295 on this particular home that this person is looking at. And then you have property tax, which can vary from one home to the next. Okay, we're going to say in this example, it's going to be about 190 on the property tax for this client. Okay, which is great if we stop here because now this client's only paying what about 1495, 1500 on their payment. However, there is also hazard insurance, okay, which is also known as homeowners insurance. If someone should slip and fall or the house should burn down, the homeowners insurance company will come in to offset debt. So, and this is mandatory in most cases on homes, unless you're putting at least 20% down. You have to have, on every house, actually, you have to have homeowners insurance that protects the lender. All right. Next, this one is kind of controversial, but it's called mortgage insurance. Now, mortgage insurance gets a bad rap, but actually mortgage insurance is your friend, because without mortgage insurance, you would have to come in with at least 20% of funds out of your own pocket to even be in the house buying game, okay? So I know folks look at mortgage insurance and go, why? I don't like this and I don't like that. We like it because it is keeping money in your pocket, allowing you to be in the home buying game versus having to come in with $80,000 to $100,000 out of your pocket or out of somebody's pocket to get in a home. Okay, so mortgage insurance, basically, the mortgage insurance company is taking on that added risk that since you don't have more skin in the game and you're not coming in with 20% down, which allows you to buy a home, and they're passing that cost on to you. And we're going to say, for the sake of example, that it's going to run right around 105 on this in this example. And that number can vary depending on the loan type that you have, depending on your credit profile, and depending on the program that you're on. Okay, but for this example, we'll say about 105. And then next is homeowners association dues, which we're going to say in this example is going to run about $55. You may or may not have homeowner association dues. It's usually for new developments or condos or things like that. And it is not part of your standard mortgage payment. You usually pay that separately, either monthly or yearly, to the homeowners association. However, if there are dues, your lender is going to factor that in as part of your housing payment. And that's where I've got the 1715 total that you saw in the last slide. So, all right. So what I'm going to do is we're going to jump into a quick break here since I covered a lot of information, let your brain thaw out a little bit. So let's take a 5-minute break and we'll be back here and finish up the lending portion. Talk to you soon. All right. We will go ahead and get things started back up here. It's not working. All right, we'll get going. My clicker was not working for a second there, but what I want to do now is just touch on real quick some a common myth and misconception that's out there, and it's that the lender is picking on you when you go into the loan process. And what this is really referring to is a lot of times people, especially if they haven't come to a home buyer class, aren't prepared for what comes next once they find their home, and they feel like the lender is just asking for too much information. Just know this, that I've been a lender for a long time. We do not love paperwork. And so when we're asking it from you, it's typically not because we're picking on you at all. If you weren't pre-approved for the loan, if you weren't approved for the loan, we wouldn't even be in this position. We'd let you know up front. What's happening is because a lot of what's happened in the past mortgage meltdown, there's a lot of laws, there's a lot of auditing that goes on, and lenders and underwriters especially can lose their jobs if an auditor comes in and asks them for certain paperwork that's not in their file. We're basically mandated to protect you as the buyer from your own self, from you going out buying a home that you and your family could not afford. And usually that means more paperwork. Okay, so if your lender is asking for documentation and you can obtain it, get it for your lender. Okay, all they're trying to do is get you the keys to your home. And sometimes you can provide information that's going to trigger more documentation that the lender has to ask for, because they know that's what the auditor is going to want to see. And the auditors are going to say, hey, how come you didn't ask for this information? And that could be 3 days after you close. It could be 3 months after you close. It could be 3 years after you close. Okay, but just know that. So don't beat your lender up. If the lender asks for some information, help them help you so they can get you the keys to your home. If it's something you can't get, let your lender know, and there's usually some type of workaround. But please don't beat your lender up or get all in a huff because they have one more item. I know I'm a lender myself, and I just did my refinance of my home, and I got all in a huff, and I had to, snap myself back into it and go, hey, Phil, practice what you preach. So it is what it is. It's kind of a pain in the butt, but it's the new normal and getting a home. Doesn't last forever. Get them that information so they can get you those keys. All right. Now I do want to cover some red flags and common speed bumps that I won't say typically, but when they do happen, can sink your ship as far as trying to close on your home. Okay, so what are some of the common things? And the reason I put this in here is to just alleviate all the fears and just put right smack in front of your face what are some of the things that happen to lenders, so there's not so much mystery on why a loan may fall through. So here goes some of the items. One is conflicting information. When you're filling out your application, things such as, you're married, where you're working, that type of thing. Try to be on point with that. I had a client who, for example, said that she was not married, and come to find out 3 days before signing, I get a call from escrow who says she was married. And not a huge deal in some cases, but in this case it was, because it was a government loan. And as I told you guys earlier, we have to count your spouse's debt on a government loan. So she had a spouse, and lo and behold, he had a house in his own name. And that house payment was so large that it did not qualify them to purchase the home. So long story short, we did figure out a way to make it work, but it was so much hassle, and the seller was all up in arms because it made the process go a lot longer, and it was just a headache. So that was a true speed bump. Long story short, try to make the information that you're sharing with us, make sure that it's true to the best of your knowledge. Change your credit status is another one. Be careful. We talked about some of the do's and don'ts that that your lender is gonna provide. One of those is, just because you just got mutual acceptance on a home and are contracted to buy, don't start going out buying stuff and charging up credit cards and doing this or that and the new couch and the stainless steel. Be careful, because with new credit inquiries, new charges that can impact your credit score, and lenders do what's called, in many cases, do what's called a credit refresh, just to make sure that your credit score is still has not been impacted negatively. And there has been cases, where someone's gone out and done those items and pulled their score down where they no longer qualify. So be careful, do your best to keep everything status quo so we can help you get those keys in your hand. Okay. Be careful on new inquiries. Again, lenders are mandated to protect you from your own self. And if they see an inquiry because you're down at the Mercedes-Benz, dealership, test driving cars to put in that third garage, don't do that till after we get those keys in your hand, okay? Because you don't want the underwriter to go, hey, they're already at a 45% debt ratio. They buy a new car, they're at over 50 and they're no longer qualified. You don't want to plant that seed, because guess what? That underwriter has to answer to those state and the federal auditors, okay? Also, be careful on lack of funds to close. The lender has to verify that you have enough funds sitting in some type of account somewhere before they can hit that button that says your loan closed. Now, if you went out and you bought some new appliances, you didn't charge it, but maybe you used cash that otherwise was sitting in your account, and that lender asked for updated bank statements, and now your bank account is $2,000 lighter, or $3,000. Sometimes the appliances can be expensive, especially if you get those high-end ones. It could be a problem. So again, kind of a common theme here, try to keep things status quo as possible. Bank overdrafts is another one. It's sometimes if you have bank overdrafts, it could be a sign that to the underwriter that you're having some financial difficulty. So be careful on overdrafts, okay? Large cash deposits. If you're putting large amount of cash into accounts, and large is relative to whatever the underwriter thinks large means, okay? It can be $500, it can be $5,000. Underwriters like to trace where money is going. Why? Because they're mandated to do so. Because homes have become the #1 place for wrongdoers, money launderers, people like that to try to wash money clean. So now the auditors, they have us looking at that stuff to make sure that there's no wrong, that people aren't using houses for wrong reasons. And that's why they want to be able to track where your money is coming from. Fortunately, cash is untrackable. So that's why we don't like to see cash. If you're putting checks into your account, that's fine, because we can trace a check and see where that money came from, not so much on cash. So if you got cash and you're a couple months away from buying, put it in a credit union or somewhere else that your lender is not going to see, unless you need to use that cash for the transaction. And in that case, there's other different ways, but let your lender know and they can kind of coach you up on what you need to do. All right. Now, for those of you who are not full-time employees, meaning that you get paid time off and things like that, if you work less than 40-hour work weeks, vacation, if you don't get those type of items, make sure during the loan process that you're working at least the minimum amount of hours that you normally work. Why? Because if you normally work 30-hour work weeks and you don't get paid time off, and you're all of a sudden working 10-hour work weeks, that's what the underwriter is going to want to use to qualify you. And guess what? That may impact your ability to close on a home. Okay, so just a little nugget there. If you have any questions on that, feel free to reach out to me or put it in the chat. The other thing I would say is be careful. On every loan, your lender is going to ask for some type of letter of explanation. It could be anything from, AKA, I go by Phil, but they'll find Philip on my credit report or vice versa. It could be for a late payment that I had 5 years ago. Okay. Don't get your feathers ruffled. Just write down the quick letter. Hey, that was a oversight. Didn't realize I didn't make that payment, whatever it might be. But don't go too deep. Sometimes they put too much information on there, and that acronym TMI is in full effect when you're buying a home. Okay, so really my point here is if you have questions, especially after you've been pre-approved and you're not quite sure, you're going through the loan process and you're going, okay, Phil kind of said this and that, and he kind of freaked me out, which is good. That's my purpose for showing this to you, so you don't shoot yourself in the foot. Just contact your lender before you do anything that you can't undo. All right. All right, so let's talk about another deadly mistake that I see often for potential home buyers. It's not having a good grasp of where their monthly budget is, where their money is going each month. So let's talk about that. A good practice leading up to buying a home is to do a budget. But before you do a budget, track your spending for a week, okay? Just to bring from the back of your mind to the forefront of your mind where your money is going, okay? Then grab your checkbook, kind of see where your money is trending each month as you write out checks, and then complete a spending plan based on that information. Everything from, entertainment to your, food, gas, mileage, all that kind of stuff, to even birthdays and holidays. Budget all that stuff in there, plug in your likely monthly payment on the home that you're buying. And at the end of the day, if it's, you bring home $4,500 a month and you total it up and it's $5,500, at least up front you got some cuts to make, because there's not enough a month at the end of the money there. So the other thing is, once you make your spending plan, don't throw it in the junk drawer because you don't like how it makes you feel, or you don't want to look at it anymore, and you were just going through the motions because I said it. It's for you. The budget is for you, so please follow it. Could be painful up front, everything is, but after time, what you're doing is conditioning yourself to live within your means, and it's always nice to have more money available to you. But sometimes it takes a little bit of work. So the other thing, just some other tips with your money, try to keep 10 to 15% of any income coming in the door from now to the time that you close on a home, just to create some extra cash fund. And 90 to 100% of any new money, which be anything such as overtime pay that you receive, any bonuses from work, even tax refunds, or maybe you just paid off a car note. You're already used to making that extra payment of $300, $400 on your car note. Just keep making that payment right into your bank account. Okay, there's something about having extra cash set aside that things don't happen. You just feel safer. The air just tastes so much better when you have some money set aside, just in case something should happen. Okay. Besides, you can't call the landlord when your water heater bursts and you're a homeowner, because at that point you are the landlord. So something to think about there. Some other things: once you do get the keys to the home, try to make one extra payment a year. Okay. By simply making one extra payment a year, you can pay your house off 7 to 10 years sooner. Okay. And so keep that in mind. I typically, when I get my tax refund, I make 2 payments, because as a homeowner, I get a pretty nice write-off. So I can make 2 payments and I'm done. If you don't do that method, another way you can do it is just divide whatever your total payment is by 12. And whatever that number comes out to, maybe it's $100, maybe it's 200 or 300, you put that towards your payment each month, and it'll work out the same. But what it'll do is pay your home off sooner, and it will save you, excuse me, you grab some water, but it will save you tens of thousands of dollars in interest charges. Even if you don't live in the house for the full 30 years, you're putting more money in your pocket versus your lender's pocket. I don't know why I got some kind of tickle in my throat here. I'll keep moving along. And then last but not least, protect your assets. Okay. You want to, once you become a homeowner, especially if you have children or family, get you some life insurance, get you an estate plan, protect your assets in case something should happen to you. Okay. Going to jump into some loan programs here. Just I'm going to do this high level, just to give you some highlights on what some of the different programs are out there are, just so you're aware when you're talking to your lenders. Okay. One is a conventional loan program, and this is a conventional just means a loan that is not a non-government. It's a non-government loan. That's all conventional really means to you. But that requires anywhere from 3 to 5% down payment off of the purchase price. It will be put into an automated underwriting approval process, meaning that your lender will plug your information into the system. Typically on conventional, it's either approved or denied. There's no gray area on these programs in many cases, unless you're working with a lender who does. But most lenders want to see the system approve it. It does require private mortgage insurance if you don't put 20% or more down. However, benefit of conventional is that once you do pay your balance down to 20% equity, then the private insurance, mortgage insurance that you pay monthly does fall off. Okay. Now, loan program, the next loan program is a jumbo. Now, this is a conventional loan, but it's typically high balance, and it just depends on the county you are, but typically that's the loan amount anything over 548. Okay, close to 550. Okay. So anything higher than that loan amount will be considered high balance or jumbo loan. That number does go up depending on the type, the number of units that you buy. Now, because it is a jumbo loan, it's considered a higher risk because there's more exposure to the lender. So in many cases, they're going to require a higher down payment, such as 10 to 20% down versus the 3% that I shared with you earlier. They also require higher credit scores, typically 700 score or higher on some of these jumbo programs. When I say credit score, I mean middle credit score. And debt ratio, we talked about 50% or 45%, in many cases 35%, again, because of the higher exposure on these loan amounts, tighter guidelines, as you can see. And cash reserves, in many cases, they want to see that you've saved up and set aside money to fall back on, whether it be in a checking account, savings account, maybe it's in your 401k, but they want to make sure that you have available cash that you can readily dip into in case you run into some turbulent times in making that monthly mortgage payment. All right. Next, let's talk about the FHA program. Now, FHA is minimum down payment close to the conventional, which is 3.5% down. The reason a lot of folks like FHA is it can be a lot more flexible, much more flexible when it comes to underwriting parameters, especially when it comes to debt to income ratio. I know we talked about 45 to 50% on conventional. That can go as high as about, I think 56% on FHA is what I've seen. And in many cases, that can be the difference of increased buying power, 20 to 30, even 40,000 in some cases, depending on the buyer's profile. So if you're wondering why someone may go FHA versus conventional, it's either they don't qualify for conventional, or if they do qualify for conventional, they have a little bit more buying power to get the home they want if they go FHA. All right. Now, FHA, one downside of FHA is the mortgage insurance, unlike conventional, which comes off after a 20% equity position. FHA, that mortgage insurance stays there for as long as you have an FHA loan. So what many people do is if they go with FHA loan, at some point they may switch over to conventional to either drop the mortgage insurance or to have the ability to have the mortgage insurance drop at some point. All right. And one other feature with the FHA loan is that it does allow for non-occupant co-borrower. someone who doesn't live in the home, but maybe it's going to help you qualify for more home because you can use their income to. They have to be sure that they do qualify credit-wise. But that's another caveat I would say that comes with the FHA program. Okay, so USDA, this is a very popular program because it's a zero down payment. So that's huge. Okay. It is, the property must be in what's called a USDA eligible area. So it's usually in what's considered rural areas outside of metropolitan areas. So if you're not quite sure if the property is in a USDA area, what you want to do is Google USDA eligibility, plug in the property address, and it will tell you, or just reach out to your lender. Your lender can usually give you a map or just plug that information or send you the link so you can regularly check that out. Now, ineligible properties on this program are manufactured homes in 2 to 4 units. Okay, so keep that in mind. And it's income specific based on the number of people who live in your household and your total household income and county limits. So here's kind of a snapshot. Grab me another drink of water. Get this tickle out of my throat as you look at some of these county limits here. So it's based on, again, the number of people in your household and the location of the property. All right. If you want more information on USDA limits, just feel free and reach out to me. The final program that we're going to share with you is a VA loan, which in my opinion is the best loan out there, and rightfully so, because it's taking care of our service members. 0% down payment. It is no monthly mortgage insurance required. The home must be a primary resident. Some of the other features is it must be a home that's in move-in condition. Okay, it must be safe and sane as well for the veteran or for active service member. Another feature is that the seller on a VA loan can pay up to 4% of the loan amount of the purchase price, towards a buyer's debt. Okay, so that's pretty cool as well. For example, the buyer may not qualify, VA buyer may not qualify because their debt ratio may be too high because maybe a car payment. Well, that seller can negotiate and ask the seller to pay off the balance of the car, so they qualify. So pretty cool stuff there. That's why I love the VA program. And the other myth out there is your VA certificate can only be used once. Just know it is reusable over and over again. All right. Any questions on that, just feel free and reach out or throw something in the chat there. So I'm going to shift gears here a little bit and touch on cash needed to close, okay? Because I know as a home buyer, first-time home buyer, you got tons of questions, but there's 2 main questions. Number one, what's my monthly payment going to be, if I buy house X, Y, and Z? And we touched on kind of how we calculate those numbers earlier, right before break. The other thing, how much cash out of pocket am I going to need to bring to the closing table? Okay. Those are the 2 big ones. Those are the 2 big questions that you have, I know, because those were the 2 big questions I had when I first bought my house. So let's take a look and see how those numbers, how your lender is going to come up with those numbers. Okay. So when it comes to cash to close, it's really in 3 parts. It's your down payment, plus your loan costs, plus prepaid items and reserves that are collected up front. Okay, let's look at it again in a different format. You have your down payment, it can be anywhere from 0% if you're on a VA loan or USDA loan, up to 5% and beyond on any other programs. Okay, then you have your loan costs, which can vary from home to home, but we're going to say typically this can run anywhere between 2 to 3% of your total purchase or your total loan amount. It's dangerous for me to say that because it can vary depending on the program and if you are buying points and that kind of thing. But the other thing to know, which is kind of the the forgotten piece is prepaid items and reserves. Okay. Now, prepaid items and reserves are items that are collected up front and held in an escrow account by your lender. And once your homeowner's insurance comes due and your property tax comes due, they don't come knocking on your door, calling you on the phone, saying, hey, we need, $1,300 for, your first half property tax. It's already sitting in there and you've been paying into it 1/12 of it month after month after month, because there's 12 months in a year. And the money's already sitting there, and they are paying out of that account for you. So you never really even know that your property tax insurance is paid. It's just paid on your behalf through your lender. Okay. Now, I always tell clients to look this almost like you would if you're renting a place and they were asking for first and last month's rent plus, per diem or prorated rent because you moved in on the 15th day of the month. Same deal here. This money, if you ever sell or refinance your home and you get a little check in the mail for $1,900 and you're saying, hey, where's this money coming from? They're just refunding you the unused portion of the money they collected up front. Okay. So let's take a look at this in a real life offer scenario. So let's say you were out with Joana and you were looking, and Joana was your real estate agent. You found a house for $400,000. Okay, you're going to offer $400,000. Now you've already been pre-approved on a conventional loan, and you want to put your minimum down of 3%. So that would be about $12,000 on this program. Okay, and we calculated the numbers, and based on this house, you have loan costs of about $5,500 plus prepaid items of another $2,500. So total, you have about $8,000 in what's called closing costs. That's your loan fees and prepaid items. Okay, prepaid reserve. All right. Now, the seller is going to cover. You're going to negotiate your seller to absorb all your closing costs, your loan fees, and prepaid items. At least you're going to ask them to do so in the offer. So that cancels out your $5,500, $2,500. So now you're coming to the closing table with $12,000, and you have earnest money that you're going to put in of $2,000. Just let the seller know you're serious about buying. That money always goes towards your cash you need to close. So now you come in with how much? See if you can guess this. Here you go. It is, drum roll please, $10,000. Okay. So in this example, this is the total amount of cash you would need to close when you're going in to sign your final paperwork, or the notary comes out to your home to sign the final paperwork. All right. This is just an example of how the numbers are allocated. Okay. So where can that cash that you need to close come from? Where can the source come from? It can be from your checking, savings, retirement account. It can be from a gift from a relative, as long as that relative is not an uncle or cousin. For whatever reason, underwriting doesn't like that, because anybody could be an uncle or cousin. And it can come from down payment assistance, or a combination of all of the above. So we talked a little bit about down payment assistance earlier, so let's take a look at that real quick. Now, there's two types of down payment assistance. There's the down payment assistance that is offered anywhere as long as you buy anywhere in the state of Washington, and it's a one-unit home, meaning that it's not a duplex or triplex. So here are some of the programs that's available. You have Home Advantage program, which goes up to 4% of the loan amount in the form of assistance for you, goes towards your assistance. So, in the last example, that was I think we said, $400,000 home. So that would be right around $16,000 to go towards the down payment or cash you need to close. Okay. There's also Home Advantage program, which is needs-based. Instead of the percentage, that one will give you a flat $10,000. Same with Opportunity program, flat $10,000 instead of the 4%. You may be asking, why would someone do flat $10,000 instead of the 4%? It's maybe because their loan amount's so low, it's not getting them enough, so they may opt to go that route. Veterans have a program that has a flat 10,000, and then there's a program called Home Choice, and this is for anyone who's got someone in their household who falls in the American Disability Act. It could be you as the buyer, it could be a child, and this one goes up to 15,000 flat as well. Okay. Now, there are some area-specific programs. We'll scratch out Seattle and East King County because the parameters for those programs are tough, so tough that no one really can qualify. So I won't go into much of that. But if you are curious about those programs, feel free to reach out to me. Bellingham has a program that goes up to 40,000. So if you're looking in the Bellingham area, let me know. We could discuss that, or let your lender know, I should say. City of Tacoma has a program goes up to 20,000. Always have to be aware of whether or not that City of Tacoma has available funds. Sometimes run out. Pierce County, as well, as last I checked, they have a program that goes up to just under 25,000 flat amount. Okay. Now on the City of Tacoma and Pierce, because those are the most common ones that we seem to do outside of the Home Advantage program. They do have income parameters based on how many people live in your household. So here they are. I'm going to leave the screen up for a sec while I get another drink of water. And for instance, if you're a one-person household, 44,950. And these numbers tend to change too with time, and next year they could be different just based on the cost of living adjustments. All right. So the thing to know on these household limits, if you make 1 cent higher than these matrices, for instance, you have 4 people in your household and total household income exceeds 64,150, you don't qualify. Okay, 1 cent more and it cuts you off. So very strict on these programs. Okay. If you want more information on down payment assistance and you're more kind of a do-it-yourselfer, you can go to wshfc.org. In the search bar, just plug in down payment assistance and it'll take you right to that info. If you're not a do-it-yourselfer, just reach out to your lender, or you can reach out to me and just let me know what you're looking for, and I'll certainly jump in and see if I can assist you. And I'll give you my contact info at the end of this, our presentation if you guys are wondering. So before I go any further, let's talk about some of the pros and cons. At least this is my personal opinion. This is not something from the Housing Commission. It's just something I come up with because I try to keep everything real for you. The whole purpose of this class is to give you the information you need to know. So from my angle, from doing these homebuyer classes for over 15 years and offering down payment assistance, here's my take on what I feel like the pros and cons are of down payment assistance. The pros is it offsets your down payment and your cash that you need to come out of the pocket with, because down payment assistance not only can cover down payment, but closing costs, or a combination of the two. Okay, so this may mean that you come out of the pocket for less money, which in many cases may speed up your timeline for buying and your ability to buy a home. They also typically, it is in the form of a second mortgage, a second lien on your home, but typically on most of these programs, there's no extra payment that's required on top of your mortgage payment. Okay. Now the downside for me is that typically it's going to be a higher interest rate, a higher payment on these programs. This does come from federal grant money that's trickling down here, and they're hedging their funds because it is considered a higher risk on their end, their higher default rate, I should say, amongst buyers, because there's less skin in the game. And when typically as a whole, when people do not have to put as much money down or any money down, they're more likely to walk away when times get tough versus tough it out, find a way to make the payment. The state understands that, and that's why the rates are typically higher. However, within this new environment we're in economically, sometimes that's not always the case. Sometimes the rate can be the same. but typically it's going to be a bit higher. So just understand that and know that your lenders, that's not your lender setting that rate. That's the state of Washington that says, hey, this is the rate that you're getting. Now there are also tighter debt ratio restrictions. So we talked about 50% on a lot of these programs is capped at 45% debt ratio. And what that can mean to you is it takes away your buying power by maybe $20,000 to $40,000. Okay, if you go with the down payment assistance program. Not always the case, but sometimes that's the case. So just be aware of that. If you're looking to go, if your lender gives you approval on down payment assistance and you want to go a higher price point, typically that may mean that you may have to do away with down payment assistance, come out of your own pocket to go higher than what they offer you. Okay. Typically the down payment assistance on its own will not cover the entire closing cost. It's just it often doesn't pencil out that way. You either would need to come in with your own closing costs, or you would have to negotiate the seller to cover that closing cost for you, which may work out fine, or in some cases, if it's a competitive offer environment, that may not quite work out. Just be aware of that. The second lien down payment assistance must be paid back. Okay, so when you see DPA, if you ever see that acronym, all that means is down payment assistance. Just know that at some point, whether you refinance your home, you sell your home, or in 30 years, whichever comes first, whatever the down payment assistance portion that you borrowed must be paid back to the state. Okay, and then also know, I put this in here. I know some of my real estate partners don't really like it, but I try to keep it real in these trainings. Just know a listing agent may view down payment assistance that you're a weaker buyer. Whatever, that's just the truth. That's just how they look at it sometimes. Sometimes not. I've had some listing agents that say, hey, if you're approved, you're approved. There are some out there that may look at it negatively. So I just wanted to make you aware of that as well. Okay. I won't speak too much on that subject because I am not a real estate agent. So I have to be careful. Like I said, I ruffle feathers sometimes when the real estate agents feel like I'm getting out of my lane, but I did have to throw that in there. It may be a negotiating piece that's not working in your favor. Okay. Now, once you get the keys to your home, I just want to make you aware that the predators are out there. Okay. And you see some of these examples, you're going to get all kinds of official notices. These marketing companies are pretty slick and savvy. They know that you're already in a mindset of, for the last 30 days, of getting your lender everything you want. So they're going to put your lender's name on there and make it seem like, now that you got your home, that this is coming from your lender, even though they just got your lender's name from public record and slapped it on the documentation. So be careful. 9 out of 10 times, it's going to, this information is junk, and you just want to put it in the junk drawer so you don't get ripped off. If you're not sure, just reach out to your lender. Take a picture of it on your cell phone, text it to your lender, or email it to them, and your lender's probably going to tell you, yeah, throw that in the garbage because it's not worth your time. Okay. Now, I do want to point out, the state of Washington has asked me to point out that they do other services besides down payment assistance. So if you see anything on here that you may want to, dig a little bit further on there, anything from one-on-one counseling prior to buying a home, to having them run your credit, a credit check, feel free and reach out to them, and they will be happy to assist and point you in the right way, or reach out to me, and I'll point you in that right direction. I think on the next slide here, I'm going to have some contact information. So here you go. You can either write these numbers down, or just take a screenshot or something, or a picture with your cell phone if you like. All right. So I'm going to finish things up, my portion anyway, with a quick story of a past client that I think will resonate with many of you. This client's name was Ed, and he actually went through a home buyer class, as you guys just have seen. And he came up to me afterwards and just said, "Hey, Phil, thanks so much for the class." He said, "I'm one of those guys that's kind of been on the sideline, just not really sure." He said, "Every time I was, was able to or thought about stepping forward, I hear something negative that just kind of made me step back. But you made me feel comfortable enough to take the next step forward. I kind of want to meet with you, see if see what I look like, see if I get qualified." So we met up. It was the days prior to COVID. And, we're chatting it up, and as we were chatting, I was able to slide over to him his pre-approval. He was all set, and he looked at me, and he just, to my surprise, he just broke out in tears. He just, visibly was sobbing for what seemed like, you know, 5-10 minutes. It probably was only about 30 seconds, but he pulled himself together and he explained to me that he is, he come from a family of renters. Just, he had he was a Vietnam War vet, had his VA certificate for years, just never really truly thought it was possible for him to own. And here I am telling him that he's been all set all the time. So it was tears of joy. He was pretty happy, to be able to take that next step, because he really did want to own his own home. Fast forward to about 2 months later, maybe it was 3 months later, he did find a home out in Lakewood, a nice little small rambler, 2-bedroom rambler. Invited me out, and even though it was a little small house, you would have thought, just looking at Ed's face, you would have thought it was the Taj Mahal that he had just purchased. So, just a cool story, the kind of stories that I love. And what my point is that there's so many other Eds out there. What you may be just like Ed. If you are interested in buying a home, and it could be, like I said, 2 months out, it could be 2 years out, but you're serious about ownership, then reach out to us and let us get you your roadmap on what you need to do. Okay. If it's not us, reach out to some lender. And also, if you, I'm going to put this at the end of our presentation as well. But if you really enjoyed some of the stuff you hear, invite someone else that you know. We do these classes for free. It's just something we enjoy doing, and it's information that people need to know about, even if they're ever considering buying homes. So there's our website. If you know anybody, just have them go there, apply, and for our next upcoming class. All right. So that's it. Also, for those of you who are not already working with a lender, I should say, or even a real estate agent with Joana coming up, we do encourage you to apply. You can apply with me. I'd love to serve you. You basically would just go to my website, www.loangotoguide.com. Click on that apply button that you see there. Once you're on the site, and just fill out your information, hit the submit button. Don't worry about making any mistakes, as far as loan amounts or anything like that. We'll walk you through the process every step of the way. So that's pretty much it for my portion. What we're going to do is we're going to, I will give you the information on the forms coming up at the tail end. As a reminder, please stay tuned, stick with us, because I have an action item that I'm going to mention at the tail end here that's going to give you instructions on how to get your certificate. All right, so stay tuned for that. We're going to have Joana Evans from John L. Scott Real Estate come up next. But before we do, we're going to take a short break, which is going to allow Joana to, short little 5-minute break, allow Joana to get all set up, and then we'll get her rocking and rolling. So go ahead and grab some coffee, take a bathroom break, what have you. That second cup of coffee, so you're bouncing off the walls. But and we'll be back shortly.
Hey everybody, I'm Joana Evans and I am going to present the real estate side of this class. Thank you for coming. I'm going to go ahead and share my screen here. All righty, so let's start at the beginning. I work with John L. Scott in Renton. I service all of Washington State. I even go as far as to finding really great brokers for clients to work with all over the world. So no matter where you go, I can find someone for you. But if you're buying here in Washington State, I think this class is going to help you a ton. So moving forward, you're here for a reason. You know that there's some benefits to owning, but I do like to acknowledge also the benefits of renting. They do exist, but you're here because I know you feel that owning might be a better option, a more lucrative option. So just to run through some of the pros of both, with renting, you've got a low financial commitment. You've got low maintenance and repair costs. Just call the landlord whenever something goes awry, flooding, electrical, you name it. There's all sorts of things that you don't have to pay out of pocket because your landlord will take care of it. Location flexibility. If you want to just pick up and move across the street one day, or at the end of your lease, you want to just pick up and move across the country, you've got the freedom to do that with very little cost to you, right? It's a short-term commitment. You can find leases that are month to month, 1 year, a lot different than a mortgage payment, which is going to range from 15, 20 to 30 years, right? So benefits of buying, obviously the investment, the equity, you've got something to show for those monthly payments, right? You're gaining interest, or in other words, equity on your investment. Fixed monthly payments, you know what your payment's going to be for the next 30 years. So you don't have to worry about rent increases. And please excuse the lawnmower in the background. We've got the landscapers out there right now. Tax incentives. So, especially in this market, tax incentives are super important because when you put them together with the low interest rates that people are paying for their mortgages right now, you're almost outpacing the rate of inflation. It's almost like getting a loan for free, like depending on how great your rate is. And, it really depends on what kind of loan you're getting. But either way, tax incentives can shave off a lot of your uh, tax liability at the end of the year. So, who can complain about that, right? And I think a lot of us love to personalize our space. You move into an apartment, your landlord gives you one accent wall that they're willing to paint for you, or they allow you to paint whatever you want or make certain adjustments to the property, but you've got to change it all back before you move out, or you're going to get charged for it. With your own home, you can do what you want with it, obviously within zoning compliance, right? Can't do anything that's going to disrupt your neighbors, but you can personalize, paint, build a fence. You can put glitter on your roof, like whatever you want to do. Obviously, you may have some HOA regulations. If you buy a property within an HOA community, that's another story, right? For the most part, on the inside of the property and most of the time on the outside, you can really go to town on making it what you want it to be. And of course, the pride of home ownership. I don't know anyone who's bought a home and has been ashamed. Okay. So, definitely a lot to be proud of in owning your own. So, this is a part of the presentation that everyone loves to hate. It is, how much do you love your landlord? And we don't hate our landlords, but we do hate how much we've invested in their properties, right? So look at this table here. For example, you can calculate what you've been paying for X amount of years and at however many dollars, and just see how much have you been investing in your landlord's property. In this example, take someone who's been renting for 15 years, 4 years at $1,200. 6 years at 1,500 and 5 at 1,900 because of course rental rates go up, right? So add that up, this hypothetical person has paid almost $280,000 into someone else's property. So that is not ideal. And I know that's why most of you are here, because you want something to show for that amount of investment, right? You want it to have your name on the deed, not someone else's. So take a minute if you'd like to calculate your pain level from being a renter. Otherwise, I am going to fly through to the next slide. Screenshot it if you'd like. Okay, so the residential buying process, much like how Phil presents, this is how I see the process from the real estate broker side. It's pretty much the same thing, except mine says select an agent first. His says select a lender first. Either way, you're not going to advance through the process without both of us. So 1, select an agent. 2, get pre-approved. 3, sit down for that buyer consultation so that your agent knows what it is you expect out of this process. So your agent can let you know what you should expect in the process and get you up to speed on the market conditions, how quickly you need to move, or, you know, depending on the neighborhood that you want to buy in, what's happening specifically in those areas that you need to be responsive to. Then you'll go out and you'll start selecting properties to look at. You definitely want to do your due diligence online. I'm sure most of you do this anyway, but you're scrolling through properties on your phone and making notes about the ones you want to look at. Send those to your agent. You guys will plan together which ones to go see. Write up an offer once you find something you like, and you're not going to have a lot of time in this market to sleep on it. When you see a property that you like, and I'm not the type to want to put undue pressure on a buyer, but in this market, you do not have time to wait. If you know you like a property, make the offer, let your agent know so she or he can write it up and get it to the seller's agent immediately. Houses are flying off the market. They're not sitting for very long. Most are selling in less than 30 days. And that includes, you know, the entire buying process where, well, we're going to go through the steps here, but from beginning to end, once the offer is made to when you close on the property. So they're really not sitting on the market for too long. Your agent will, as number 6 says, negotiate on your behalf. So there could be some back and forth with the seller's agent and your agent on, you know, there's likely going to be a lot of other offers on the same property. So there'll be some negotiation involved to try to get your offer accepted in terms of what your agent is, how they're going to work for you. Once you finally make an offer on a property and it is accepted, you go under contract, or what is called mutual acceptance. So once mutual acceptance is reached, you'll move on to number 8, which is removing all the contingencies. You've got inspection, financing, and title. And we'll go more into that a little bit later. But those are points in the transaction where you can walk away from the deal if it's not up to your standard or what you want for your purchase experience. We'll go into it again. Number 9, though, funds are released once all the contingencies are met. That means that the lender is going to give the money that you're borrowing to escrow, and escrow will then fund the seller. Then your transaction will close once escrow gets recording numbers from the county. It's kind of just a unique confirmation number from the county that the transaction has gone through, and you will be able to get keys and take possession of your property. So, shopping for an agent, what are your 3 top qualities? And go ahead and throw them in the chat. You'll probably see a lot of them listed up here. These are all things that I found to be super important with buyers that I've worked with. So communicative, you don't want someone who's not accessible to you, not someone who's going to ghost you and you're wondering where they're at, especially in this market where we've got to kind of move quickly on properties that we have interest in. you want someone who's going to be accessible to you. Now, remember, they are human and they do have other things to do outside of you. So if they don't respond in like the second you call them, it's okay. Give them a few minutes, give them a few hours, just expect a reasonable response from them. If you can't find them for 24 hours, then there could be an issue. But for the most part, if you're hearing from your agent on a regular basis and they're generally reliable, then you're golden. Okay. You want someone who's able to explain the forms to you and all of the language. There's a lot of it, so it can be confusing sometimes, especially if you're generally overwhelmed by a lot of legal jargon. You want someone to explain that to you, someone who's diligent, provides data if you want it, respects your culture, understands your needs, and someone who's in general a good listener and willing to educate you. So think about those things before you select an agent. What is it that you need from them? And interview agents. Don't just go with your cousin Billy Boy because he's your cousin and you want him to get a good commission. Like, you want to interview agents because this is likely the biggest transaction of your life yet, right? So take it super seriously. Now, the law of real estate agency is basically a document that describes your legal rights with dealing with the real estate firm or the broker and the broker. The broker is technically the agency that the agent works for. Although both are referred to as brokers, this document describes the duties of the broker and the agents. What a dual agent is, that's when a brokerage is representing both the buyer and the seller. It goes into the duration of the agency relationship with the client, how agents are compensated, and more. So definitely give this a read before you go deep into working with an agent. I can send you a copy of this if you would like, or you could probably Google it online. It's the law of real estate agency for Washington State, and make sure you're getting an updated copy if you do decide to get it on your own. So this is the buyer agency agreement. This is something that we agents have our buyers sign, just high level to agree to working with us. If we're going to show you properties, we want to ensure that, if I show you house on 123 Apple Street, that you're not going to go buy it from your cousin Billy Boy instead because I showed it to you, right? So it's something that not only protects the agent, but it also protects you as a buyer. If you want to go through here and read the terms on your own time, I can definitely send this out to you too, and you can kind of review it. It talks about the term of the agreement, talks about inspections, compensation, how the agent is paid most of the time, 99% of the time. The buyer's agent is paid by the seller. I've never seen a buyer's agent or a buyer have to pay their own agent. I've not personally seen it. Not to say that it doesn't exist or can't happen, but it usually works within the seller's best interest to pay the buyer's agent. And we could have a whole conversation over why that is true, but you'll find that the majority of listings, nearly all listings, will have an amount that the seller's agreeing to pay to the buyer's agent. Okay. But if you're working with an agent other than myself, make sure they're looking at that point in the listing. Is the seller willing to pay the commission? And if not, this form right here will outline how much you agree to pay your own agent if the seller's not going to pay. So again, let me know if you have more questions about this. I'm happy to send the agreement to you and go over it line by line. So I'm pretty sure most of you have a wish list for your home, right? Most people not only have their preferences, where it's located or what schools it's around, or all sorts of things like that, but also down to the cosmetic stuff like granite or Carrera countertops and soft closing cabinets, a bidet, like those are all things that are super cosmetic and super within your control to change, and not always high priced items, right? So when you think about your wish list, don't get so focused on the cosmetic stuff. Think about the location. That's definitely not something you can change once you purchase a home, right? Think about the general price range. Is it going to meet your long-term needs? Are you going to be needing to move in aging parents later? Like, do you need a master bedroom on the main floor? Things like that. Like, think about those really high-priced items that you would prefer not to have to pay down the line, or things that are impossible to change, like the location or the lot size. All right. Now, once you find houses that you want to make an offer or view and eventually make an offer on, I'm going to pull, or your agent's going to pull a property report like this one. This is one that a resident would see. The agent version has another section in it called agent remarks, where it gives a little more details about the property and like viewing instructions and offer instructions. But for the most part, this is what it looks like. So you're going to see the list price. If schools are important to you, you'll often see like where it's highlighted up here, school information. Oftentimes they have the schools listed in here, but I still advise you to do your own diligence in determining if this property falls within the school boundary that you want it to. I have found listings that have been inaccurate. So it says it's assigned to a certain school, but it's not really. So work with your agent. Your agent should be able to help you identify that for sure. When it comes to the price, you see the price here, annual taxes and HOA dues. These are numbers that I, as your broker, will run by your lender to ensure that all things considered, you're still able to afford this property. So it's not just about the list price. They do also have to take into account the taxes and HOA dues, because that's going to impact your monthly payment and your ability to repay the loan in general, right? So run these listings by your broker so that they can run it by your lender in good timing, and decide if it's going to be an appropriate idea to take you out to see this house, right? For the interior features or even the exterior features, you may see things about the property that you really, really like. Make sure your agent checks the marketing remarks to ensure that the things you love about this house are actually included, okay? I've seen homeowners take fruit trees with them. They've taken appliances with them. Even if it's in the picture, you can't rely on the photos, right? Make sure that in the remarks, you are getting that what you see is what you get, or not what you get. You just want to know what's going to convey with the property, okay? And you can, in general, not assume, but in general, expect that anything that's a part of the structure, the house, like bolted into the ceiling, like the chandelier or something, generally comes with the house. But the chairs, the garbage can, the TV, the personal property staged in the house most of the time does not. So if that's something that you want to negotiate with the seller, to sell their furniture to you or some other piece of personal property in the house, that can also be worked out some of the time. So work with your agent on that to get that message across to the seller that you're interested in personal property. So earnest money deposit, you've probably heard of that, probably have some questions about what it is. So it's a good faith deposit, basically, to show the seller how serious you are in purchasing the property. And it's refunded to you when you don't apply it towards your closing costs. Like in the instance, the seller is agreeing to pay for your closing costs, or as long as you don't back away from the contract without a valid reason, like during a contingency period. If you just, you're under contract with this house and across the street, another house comes on that you like a lot better and you just walk away from the deal, you're going to forfeit that earnest money. Okay. That's not a valid reason to walk away from the deal. It should be within the contingency periods provided. How much should you offer? Generally, 3 to 5% in this market, and the more the better. You don't want to offer more than 5% because legally the seller can't collect more than 5% in case there are damages, and you end up having to forfeit the money. So the most you can forfeit is 5% anyway. So you want to stay in that 3 to 5% range. Usually I say 1 to 5%. But because this is a really strong seller's market, I wouldn't recommend offering less than 3. The King County Sewage Treatment Capacity Charge. This is something that homeowners are paying for any property that was connected to the sewer line in King County and some parts of South Snohomish and North Pierce counties. It's billed every 3 months. It's about $68.34 per month. And it's for any property that was connected to the sewer line on or after February 1st of 1990. And it's paid for the first 15 years after connection. So it could be a house that was built in 1900, but if it was connected to the sewer line in like 2000 up through 2015, it's going to have to pay this charge. So any house that was built after 1990, same thing. If it was built in 2021, you're going to have to pay this charge for the next 15 years. And the charge follows the property, not the owner. So if someone is living in a property that you're making an offer on and they've already paid the first 10 years, you're going to assume the next 5 years once you take ownership of the property. So the lead paint disclosure, this is something that you should be getting from your agent for any property you make an offer on that was built in 1978 or previous. It's not to say that the property has lead paint, but that was a time period, 78 and before, where lead paint was used. So they just have to give you a disclosure about what it is and the implications of having lead paint in your home. The home warranty protection plan. So this is not homeowners insurance. What this is, it's a plan that you purchase one time once when you purchase your home, and it helps cover major systems and appliances for the first year, depending on what plan you buy, for the first year of home ownership. So if anything were to go out, toilets, doorbells, dishwashers, electrical, heating and ductwork, if you need to have repairs done, it's really just a matter of paying $100 for someone to come out and look at it and fix it if you pay for the protection plan. Different plans cost, varying amounts, but I purchased this plan for all of my clients and it's about $340 and each call is $100. So if you need to get your plumbing system fixed, instead of paying for the entire plumbing system or plumbing issue, which could be, who knows, $5,000, you're just going to pay $100 for a phone call and they're going to come out and fix it. So this is definitely cheap insurance. You want to get it. I don't even care if it's new construction. Things go wrong with new construction too. So make sure you have a home warranty plan. Or if you're working with me again, I'm going to buy it for you because I want that first year to go smoothly for you. I don't want you to experience any like super pricey repairs during that time. So title and escrow, you've probably heard of it, probably confused by it by a lot of people. Title is just legal ownership and the legal right to use a piece of property. So we're talking about the sellers here. Initially, defects on the title can prevent a seller from being able to sell the property to you. So during the title contingency period, even before that process starts, we have the title companies, or the listing agent has the title companies working to make sure the title is clear and available for the homeowner to sell, so that there are no hiccups in the transaction. So even though a seller might have purchased a property and they've made all their payments on time, and they could still have clouds or exceptions on the property that prevent them from selling. It could be past ownership claims, liens. Maybe they owe back taxes and the IRS has a lien on their property. It could be a construction loan. Maybe they did a remodel but didn't pay the construction company. The construction company can put a lien on their property. And easements. Easements are basically another usually adjacent property homeowner having the right to use your property for a specific purpose. It could be a driveway going through your property so that they can access their home from the street just to get in and out of their own property. There could be all sorts of reasons for different types of easements on a property. So that will outline what they are, and you'll have a period to review the title yourself to see that there's nothing having to do with the title, including easements or anything that are not acceptable to you. You can actually walk away at this time if you don't like something about the conditions or covenants or restrictions on the property. So let's see, escrow. They are the impartial third party that manages and disperses transaction funds. They also make sure that all the I's are dotted and T's are crossed in the transaction. All necessary actions, deliverables, forms are taken care of and in place so that the transaction goes smoothly. They are not working on behalf of the seller. They are not working on behalf of the buyer. They are neutral. So they're also the ones who get the recording numbers from the county once the sale goes through and gives you basically the green light to take possession of the property once the transaction has closed. So I have this little video here. I should probably find a better one because this video was done by a title insurance company for the state of California. And it's kind of written for the perspective of the seller. So it still just kind of gives you an idea of what title is and how title insurance works to kind of protect the sellers and allow them to be able to convey the property to you with little to no issues. All right, so in a nutshell, that is title and escrow. If you have questions about it, I wouldn't be surprised. It's kind of a lot. Go ahead and throw them in the chat and we'll definitely get those answered for you. Moving along, I just wanted to review with you some common documents that you'll see in your offer package. It's, for one, the purchase and sale agreement. So that is like the center of your offer, and all the other addenda that go with it. It just kind of centers around the information in that purchase and sale agreement. So that purchase and sale agreement will talk about who the buyers and sellers are, information about the property, what you're offering for it, what's included or excluded, all sorts of details about the offer. It will generally come with the financing addendum because you are being financed for the property. It talks about how you're going to pay, how much you're going to pay, what you're putting down, if anything, or just all of the terms of the financing side of the contract. The inspection addendum, you'll also see outlining the terms of the inspection, the contingencies, all sorts of details around that. I can definitely forward samples of these forms to you just so you can get familiar with it before actually making your first offer. So feel free to reach out to me and let me know if that's something that you'd like. So just kind of honing in on the inspection. So important. I know that buyers, especially in this market, get really antsy and sometimes desperate to purchase a home that they'll just waive the inspection. They say, I don't care what needs to be fixed, just we'll waive the inspection. And that's very attractive to sellers because they don't have to fix anything, right? But then you're stuck with any repairs that need to be done. I give all of my buyers this form right here that just outlines what an inspection is, what it isn't, why they're important. And just so you know, the consequences of waiving the inspection is that you do lose the right to make any requests for additional repairs or to back out of the deal before it closes without losing your earnest money. Okay. Again, even if it's new construction. There are issues with new construction a lot of the, I won't say a lot of the time, but more common than not. Okay, it's more common than most people think. Um, I still always recommend getting an inspection, no matter how new, how old. Um, yeah, it's, you don't want to be stuck with something that's going to cost tens of thousands of dollars, possibly, or who knows what. You know, it is a risk that you take if you decide to waive it. But I'm definitely that agent that will harp on getting the inspection done. Now, this is something that you pay for out of pocket. I'm glad I remembered this. So the inspection costs about $200 to $500 for the majority of properties I've worked with. It's something you have to be ready for, to pay out of your own pocket. It's not refunded. And each property that you make an offer on, if there's an inspection, you're going to be paying for it. Okay, so just keep that in mind. So the appraisal contingency. Well, first, what's the appraisal? It's the opinion of an appraiser on what a property is worth. These are ordered by the lender to make sure that you are offering, or that the property is worth at least what you're offering, so that in any unfortunate instance that they have to take that property back, they'll be able to sell it and recover the money that they loaned on it. And the appraisal contingency is the language in the contract allowing you to walk away from the deal if the property is not worth, according to the appraiser, what you and the seller agreed you'd pay on it or pay for it. If the appraised value is lower than the offer amount, you have three options. You can renegotiate a lower price with the seller. You can pay the difference between the loan and appraisal amounts. Maybe you'll pay, say there's a $10,000 difference. Maybe the property, you offered 300,000 on it, but the appraiser appraised it at 290. Maybe you say, okay, I'll pay 295 for it, right? I'll still pay above what it's worth, but you as a seller have to bring the price down from the 300,000 that I originally offered and just accept the 295. So you're kind of meeting in the middle, even though it's not, you're offering more than the appraised amount. You're not offering as much as you were going to, and they're taking a little bit less than they originally accepted from you. Or three, if you don't want to pay any additional money above the appraisal amount and the seller doesn't want to bring the price down from what you offered, then you can walk away and take your earnest money with you. Okay. Now, if the appraised value comes in higher, no problem. The bank's more than happy to give you the money to purchase that property because they know they can recover it back, or they're very confident they can recover it back. In the unfortunate case, they have to somehow, or for some reason, take that property back on. The consequences, again, if you're going to waive that appraisal contingency, which a lot of people are doing now, although I don't recommend it, is that if the appraisal comes in lower than the offer amount, your lender may not want to loan you that money on the property, and you'll need to come up with the difference to pay that on your own. If you can't make that payment on your own, the seller won't lower the price, you will have to walk away from the deal and forfeit your earnest money. Okay, so that's why I advise buyers to not waive that appraisal contingency. So much like bill covers, these are typical fees paid by buyers. So many fees, right? These are your closing costs for the most part, and HOA fees. Oftentimes, these can be negotiated with the seller to pay on your behalf. So generally how that works is I help my buyers to basically offer above the list price to not only incentivize the buyer to take their offer because you're paying more than they're asking for, but also pay on top of that the amount to cover the closing costs, so that you can ask for those closing costs from the seller without coming out of your pocket to pay them, if that makes sense. So instead of paying $15,000 or however much it is in closing costs, you're offering that amount in the form of the loan that you're borrowing from your lender to the seller and then asking them to pay for those costs out of their net proceeds. So the fees, some of these are fixed fees and some of them vary depending on the sales price of the house. Just really depends on the property. But for the most part, I'd say closing costs range anywhere from 3 to 5%. 5's kind of high on the high side, but just somewhere in there, you can expect to be responsible for that amount if not negotiated with the seller. So 10 deadly mistakes, kind of like how Phil does. I'm going to just breeze through these pretty quickly. As a buyer, you don't want to choose a broker who's not committed to a strong business relationship with you. So in real estate, our relationships with our clients should extend far beyond the transaction. We should be there for you all throughout the years to answer all of your questions, give you information on your property, even at times help you troubleshoot issues that you're having. I've had to help a lot of my buyers with things that maybe they just didn't understand or actual problems that arose immediately after closing on their home. You don't want a broker who's going to just ghost you once they collect their commission, right? You want someone you can call on and kind of help ease you into your home ownership and just, again, in general, be there for you through the years to be a resource to you. You don't want to make an offer on a home without being pre-approved. For one, a seller probably won't give you the time of day in this market without a pre-approval letter, okay? But if they do, and they do accept an offer from you, well, you don't want to be on the hook for a property you might not be able to afford. So always work with your lender first to see what you can afford, what they'll approve you for before ever making an offer on a home. Unless you've got cash to pay, I would definitely avoid doing that. Also know the total costs involved. Again, you're taking this class so you kind of have a general idea of what the costs are. You're kind of doing your diligence, so kudos to you. But just make sure when you start looking at specific properties that you're working with your agent and your lender to know exactly what it is you're going to be paying. And you don't want to be left in the dark where that's concerned. Don't limit your search, your home searches to open houses, ads, or the internet, especially in this day. We've got COVID going on. Not everyone's having open houses. And when it comes to ads, not all agents or sellers market their homes very well. So there may be a property for sale that you see no ad for, no list, or maybe a poor listing even. You want to work closely with your agent to identify these properties for you. And definitely when it comes to the internet, I know a lot of people run to Zillow, and not trying to dig on Zillow because it's a really cool website. They offer cool tools, but they're not always offering real-time information. So your agent's got access to the multiple listing service, which is like the database of all listings. That's the same database that feeds Zillow's information that they blast out on the internet, but I don't believe they refresh their data in real time. I think it might be a day behind. So you can see a property that you love, but maybe it went pending yesterday, but it still says active on Zillow. So definitely work with your agent to identify properties and their associated status in real time. Thinking that there's only one perfect home out there, you got to be flexible, especially in this market. Like, you don't have a whole lot to choose from. One, because sellers have been a little bit hesitant since COVID, or a lot hesitant since COVID, to put their homes on the market. So there aren't as many available. This is why buyers are having to be super aggressive. And not just sellers being hesitant, there's other factors why there aren't as many properties, but you definitely want to be flexible and thinking about what type of homes will work for you, okay? Not considering long-term needs. We went over that, you You have parents who are going to have to move in with you later down the line. Your kids, if you have kids, are going to grow up one day, and what are their needs going to be for the property that you purchased today? What are those needs going to be down the line, and is the property going to work for you then? If you plan on staying in the property you're buying now for so many years, just think about what the long-term needs are, what your objectives are, and use that to inform your choices on which properties you look at and offer on. Not following through on due diligence. Again, you want to have all your I's dotted, your T's crossed. If your lender or your agent asks you to do a certain thing, do it quickly. Don't sit on it for days. You can't afford that in this market. Don't be afraid to ask questions. There's no dumb question. Just do everything you can to keep yourself in the know and in the light, and definitely be super responsive to your agent and your lender, because they're working for you to help you reach your real estate objectives, right? So do as much as you can. Let's see, not having a home inspection. I don't know if I can harp on that any more than I already have. Have your home inspection, okay? Not examining insurance needs and warranty needs. Insurance, I know people don't want to come out of extra dough up front, but dishing out a few $100s to save yourself thousands of dollars down the line is generally worth it. So make sure you buy that home warranty protection plan. If you're not working with me, again, I buy that for you, but if you're not going to work with me, you make sure you get that plan, because you never know, things can come up that weren't picked up in the inspection, and you could be stuck with some major repairs. So I wouldn't want to see any of you stuck with that. And then last but not least, this is something I hadn't covered yet, but you really want to shop well below your pre-approval amount in this market, because you're going to need a lot of wiggle room to offer above the list price and ask for your closing costs if you don't want to pay those out of pocket. So for instance, somebody who, I have a client, I'm looking at my whiteboard back here, a client who is approved for $375. I'm having her stay in the $300 to $325 range in terms of list prices, like what houses she's looking at, because she needs all of that extra wiggle room, all of that leverage to cover closing costs and to offer the seller more money. And even that is probably not a lot of leverage. People are offering 50,000, 100,000 more in these markets. And so it's crazy, right? It's bananas, but it's not impossible. I just recently sold a property to someone that had only been listed for 3 days, and she wasn't the highest bidder, but she still got it, right? So it's all about how your agent presents the offer and the ability to negotiate. So anyway, that's it for my part, and I'm so happy to answer any questions that you have. I hope I didn't go too fast, but please throw your questions in the chat and I'll be super happy to answer them. If you need to get in touch with me, here's my phone number and email address. If you have any friends or family that want to sign up for the class, you can go to bit.ly/buyer. Go ahead and screenshot this if you'd like, and send them my way. We're happy to work with them as well and answer any questions they have. So thanks for listening to my spiel, and hope to make some buyers out of you guys soon.
All right, so hopefully you guys got some great information. This pretty much it comes to the end of our class. As I mentioned earlier, we're going to, now is the action item, to get your, what we're going to do is send over to you a registration form to fill out and get that back to us. And along with the registration form, which has your, we're going to have you fill out an assessment form, if you don't mind, just letting us know what you thought about the class. And then once you do that, we will get you your certificate. So we'll have that emailed out to you. So the action item I'm going to need you to do so we can get you your registration form, so we can get you your certificate, is to, I'm putting in the chat right now a code. And what I want you to do is look in the chat, find that code, and then email me back that code to the email address you see on the screen. Once you do that, I will send out the registration form to you along with the class assessment form to fill out, return to me. Once I receive that, I can send you your certificate. Okay, so step one is to take the code and email it to this address. Step two is I will send you the registration forms along with instructions on what to do next, which basically is to fill it out, send it back to me. Upon receipt, I will send you your certificate. A couple of things, be sure to check your spam, just in case sometimes I've found that it goes into your spam or junk folder. If you're looking for information from me, check there first. The other thing is try to get this done within the next 24 hours. Sometimes I have attendees who wait 3 and 4 days. I teach so many of these classes that it's almost going to be impossible to track down the different codes and things I send out. So please do me a favor, have this done within the next 24 hours so we can get that back to you. And if you happen to have any difficulty, please call the number that I listed there, 425-260-8999. That's my cell number. If it goes to voicemail, just leave a message. I'll get back to you. But if you have any problems with this, let me know. Sorry for this extra hassle, but it's the state of Washington has us go through some extra steps here just to make sure that you've actually attended, which gives you the ability to have these classes virtually. So thank you guys so much for your attendance. What I'm going to do is sign off here, but I will keep this screen up for a little bit longer, just in case someone wants to jot this information down. Again, please check in the chat for the code and then email that to the email address you see on the screen here, and we'll make sure we get you your registration, then followed by your certificates. Talk to you soon.